Good day, good afternoon, and welcome to our 8th installment of the JSE's SA Stock Pick session. It's really exciting and lovely to have you join us. There's always a sense of excitement as we kick off these sessions. And we're pleased to say that we're almost a year into this series. We kicked off last year, August. As mentioned, this is our 8th installment, and we've had real fun getting to know industry experts as well as engaging with you in terms of really getting to know our audience and to reach quite a unique audience to get to know our South African stock markets better. To date, we've had over 30,000 views, so it is really incredible that you tune in, and we appreciate the interest that you show as you get to know what's in the market. As always, we are bringing you industry experts to tell you about some of the topics, themes, and trends that are on their radar now, as well as to give you 3 stock picks that they would like to recommend in terms of areas of interest. To note, as a disclaimer, the JSE does not give advice, and while we do not endorse or give guidance in terms of what these stock picks are, we are really thrilled to facilitate these sessions and really welcome your interest in the SA stock picks. Today, we are joined by 4 industry experts, all of them here for the first time today. So it is really warming for me to welcome Wayne McCurry, Portfolio Manager at FNB. Good afternoon, Wayne, and thank you for joining us. Alton Oliver from Alawani Capital Partners. Alton is a Portfolio Manager at Alawani. So lovely to have you on the show, Alton, as well as to be in our building today, which is quite cool. It's the first time we've had a mix of some people in person as well as those dialing in. A warm welcome to you, Zaid Parak. Zaid is joining us from Aon Investment Managers, where Zaid is an investment analyst as well as portfolio manager, as well as Tatenda Chupanduka from a portfolio manager from Independent Alternative Investment Managers. So welcome, Tatenda. Lovely to have you on the show. And Tatenda's adding a new flavor. I won't burst his bubble, but adding a new dimension for us. So guys, the brief is simple and it remains the same. I've chatted to our panelists or our speakers before this and really highlighted the fact that we want to keep the session light and informative. I also encourage you, the audience, to please kick off with a whole host of questions if you want to. We'll try our best to get through them, and we have our team just going to be calling them out at the end. So if you have any questions that you'd like to ask any of our speakers, please pop them on the chat. It is a live chat with a rebroadcast hereafter. But if you have any questions, we'll do our best to try and get to them. And we want to have this as a session to get to know some of the opportunities in the South African capital markets, but also to get to know the people in the industry. So each speaker is going to give us 3 SA stock picks. We keep them on a time limit to keep it sharp and punchy and really to keep it informative. But we also want to get to know our speakers, some of their drivers for themselves. The more information they share with us that is of interest or unique facts is always exciting for us to get to know some of the brain drivers behind those beautiful minds. So I'm going to ask each speaker to kick us off with a brief intro, maybe tell us something about yourself that we may or may not know. And then please go into your stock picks. As mentioned, 3 stocks, and we'll try to keep it to about 2 to 3 minutes per stock. So in total, you'll get about 8 minutes with each speaker, and we'll tackle some questions at the end. Without further ado, we're going to kick off this session with Wayne McCurry. Wayne, you have a great social media following and are always in the public domain. So it's lovely to have you on SA Stock Picks today. So over to you.
Yes, well, thank you very much, Valdine. I wasn't expecting to give some story about myself and what my own personal drivers are, but maybe 1 or 2 little comments about stock markets in general. Everything's cyclical, basically. There are actually very few structural changes, and we're just going through a normal cycle now. It just happens to be the down part of a cycle after an incredibly strong and incredibly powerful, in fact, abnormal upcycle. So people who are relatively new to the market, don't panic. It's a bear market, but they happen quite regularly, and we will all recover from that. So I suppose let me get on with my stock picks now. It's not really picks for a competition. You know, these are not shares I've chosen on a 12-month time horizon to actually go and make money in and win a stock pick competition. They are a little bit more of a value bias, certainly Momentum and AVI, not because the companies themselves are spectacular or have got great growth potential. It's just really the price of the share relative to some sort of intrinsic value that I'm choosing those two. And then Impala, I think, is a structural situation. I think there's great demand for platinum group metals going forward, but I fully realize I may be well early here by a massive margin. In other words, the share price could fall quite a bit more from this level, but still on a longer term, 3 to 5 year basis, I think it shows very good value. I think the whole market itself is approaching a good buying opportunity, as I mentioned early on. But let me go through the shares then, and then just starting with Momentum Metropolitan. I mean, the share price peaked over 30 Rand in 2014, and it's come back a long way, trading at 14 Rand 50. You know, it sat for about 3 years, round about the 18, 19, 20 Rand mark. But certainly this year, it has come back quite a bit. And this is very low in comparison to its embedded value. So they had a tough time in 2020, strong recovery in 21. The present value of their sales is actually very good. They've had very good sales volume growth over the last 3 years. The value of new business, which is an actuarial way of working out the potential future profits from the business they've written, was up 20% in the last year. So they're not really struggling too much to get volume out there. The margin was maintained quite well on their new business at just over 1%. But as I mentioned in the introduction, the embedded value, now the embedded value is also an actuarial concept, but essentially it's a calculation of today's value of all future profits for policies that they have on the books and policies that they intend to write. So it is a little bit of a theoretical value, but I found out there's actually quite a good benchmark to use to value life insurance companies against, and that has been static at 28 Rand. So I mean, it's a tough environment, you know, it's very competitive in the life insurance industry, in fact, in financial services in total in South Africa. But the embedded value at 28 Rand and the share price is 14 Rand 50. I mean, that's almost it's a massive discount. I mean, the share's trading at 50% of a theoretical book value. To me, this is a very, very high level, and it's the highest I've seen in Momentum in many, many years. Their return on equity is not bad at 16%. I mean, it's certainly not great, but, you know, they are still getting a half decent return on equity. I've mentioned that it's not a particularly good trading environment for financial services in South Africa. The business itself is relatively mature. You know, the life businesses haven't done well over the last 3 years. Luckily enough, their death claims peaked in August and September last year, and they're now very much back at normal levels. They have got a few new businesses that they're trying to grow to try and compensate for the mature part of their business. But the real motivation for Momentum Metropolitan is just simply the discount to a book value, if you want to call it that. The discount is huge, and I think there's potential for share prices to go up quite materially. Dividends not bad. I mean, it's not the best dividend yield in the market, but certainly the dividend can be maintained. They've got enough capital. Right, turning to Impala now, as I mentioned in my introduction, shares can fall, I think, quite a bit way more than the current level. I mean, look, they have come off quite significantly from, let's call it the 290, 300 Rand level, 3,000 Rand level down to 1,600, but they could fall more. I don't think we'll see as much weakness as we saw from 2013 through to 2015. I think those were fairly unique circumstances, unfortunately negative for commodities in general, but I still think there could be some downside on the share. Dividends are fantastic. I mean, mining companies have never made more profits than that, and have never had stronger balance sheets than what they've had now. But the dividend should be okay going forward, even though profits should fall. Palladium, platinum, all the PGM metals, they all rolled over, and I think there's more downside. The next major bull market is probably only in 2 years' time, 3 years' time. So even though the prices have rolled over, I still think there's more downside on that. Like all companies, they face big inflationary pressures. I mean, the prices of fuel, everything is up, so they've got double-digit inflation in the system virtually baked in for the next year or two. Palladium and rhodium look good, probably still be in deficit for a while. Motor car production should increase this year based on last year. And just a little bit about battery electric vehicles. I mean, there's 1.3 billion internal combustion engines in the world at the moment. There's 100 million new car sales each year, and maybe by 2030, let's call it 25 million of that 100 million will be electric vehicles or battery electric vehicles. So although this is an unstoppable move to electric away from carbon, it takes a long time for this to actually have effect. So on our investment time horizon, 3 to 5 years, the move to electric from internal combustion is actually marginal at best. I mean, in 30 years' time, there won't be any more internal combustion engines, but that's just too far into the future. Free cash flows are good, dividends are good. Some overhang maybe because of the deal that they're busy in. Spoken about the cost curves and the costings and the increases in the prices, so that is a risk, but certainly longer term on a structural basis, Impala looks good. The Angloval Industries, this is truly a quality company. You know, maybe they should unbundle the I&J business because that's always been a very, very marginal, or not marginal per se, but a very cyclical business. But right now, the share price is down at 65 odd rand. I mean, it peaked in 2018 at 120 rand odd. You know, it's fallen a long way, and the price is just too low for a quality business like AVI. I mean, you're getting a 7% dividend yield. And I mean, this company can generate cash. I mean, they generate massive amounts of cash. They've got very low gearing on the balance sheets. They are in a difficult situation now. Demand is stagnant and costs are going up, especially in their snacks business. The cost increases in the biscuits, for example. Palm oil has gone up enormously. So, but AVI is quite clever. They'll sacrifice volume to try and maintain margin. So they push through selling price increases to cover costs. High dividend yield, price earnings ratio going forward, low double digits, which is very good for AVI. They have paid special dividends in the past because of their cash flow. Their return on equity and return on capital invested is very, very high. Tea and coffee is not doing that well at the moment, big discounting by competitors. I&J, I've spoken about it being very cyclical. Last year was quite good because of abalone, but it's still a very cyclical business. Also, they've got a reduced total allowable catch in I&J. Snackworks is looking quite good, and it's really a price recovery issue. And that's the end of my presentation.
Excellent. Thank you, Wayne. Really awesome. A couple of 2 cents from myself. Nice to see diverse stocks. You've given us Momentum Metropolitan in the financial services space, Impala Platinum in a mining segment, and then AVI from a consumer focus. Also lovely to hear the opportunities and the value as you've highlighted in our South African market. And also exciting to say, even though there's some of them have a longer term trajectory in your thinking, things like, Impala's contribution to a green economy, and as the South African, companies transition and change into something that is really relevant right now, it's quite cool to watch the journey, also to see how this is prioritized at a country level in terms of our focus of what's relevant or not for a just transition. So really awesome, Wayne. Thank you for those insights. We do have a question already, really someone asking about in respect of a global recession, our cash investments, the opportunity or the area of interest at the moment. I'll come back to the question at the end of the session, so any one of the panelists can answer because it is a general question, but I thought I'd just put it out there so you can think about it in the meantime. Great, thank you. So Zaid, welcome, and we'd love to get to know you a little bit better. Tell us something interesting about yourself, and then straight into your stock picks, please.
Thanks, Valdine. Great to be here today. Talking about market and cycles, it made me think about a little bit of a hobby of mine, being cycling. I've been told that I enjoy the sights and the sounds more than the speed. So that's just something a little unrelated about me. Maybe just diving straight then into the stock picks. I think as an overview, it's important just to get a sense of our philosophy and process. So it's based on expectations investing, where we look for mispricings in the market and try to identify what they are and take action and execute on those mispricings. We think with the current market volatility, it presents a lot of opportunity. It's probably the best time to be a stock picker, and we're taking advantage of a lot of the mispricings in the market at present. Whether it's upcoming, recessionary fears, whether it's Ukraine, Russia, there's always mispricings, and potentially now is a great time to execute on them. So just to delve directly just into my stock picks, first off, I'll start with AVI. So AVI is one of South Africa's largest FMCG goods producers. It has very well-known brands such as Bakers, Five Roses, I&J, and Spitz, just as an example. The company has been impacted by many issues. The issues at present, from a consumer downtrading environment where consumers shifted a lot of their buying from more established brands to more house brands, private label goods in general. Number two, the higher input cost inflation environment, as more recently as a result of the Ukraine-Russia war, where we saw the impact of higher maize and wheat prices, as well as palm oil prices. And secondly, just generally lower GDP growth has impacted the company. We think at present, though, that AVI, is really penalized quite harshly by the market. We've been told by industry experts, potentially this is the worst that they've seen it in over 20 years. But with that, we think that every crisis creates that opportunity. And we think at AVI at present, since May, we've seen wheat, maize, as well as palm oil prices actually coming down over 40%. AVI is a highly cash generative company, pays a solid dividend, and at present it has a high quality management team. So at present, we think that AVI stands to benefit quite significantly from here. We believe when the market presents you a gift, AVI is one of those gifts, and you should grab it with two hands, and you could really do well over the longer term. Providing some sort of stability in the share was also not too long ago. Mondelez made potential offer for part of the business, and we believe that gives that confirmation just in terms of some of the value from a global perspective. My next stock that I'm going to talk about is Bidvest. Bidvest is one of those companies where you could go as your consumer through the day and you wouldn't really know, but Bidvest has impacted you in more ways than you can imagine. So Bidvest is a large conglomerate business. It ranges from everything from cleaning and hygiene businesses to commercial products, as well as motor retail. Really, it's significant in the economy, no matter what sector you consider it. Bidvest is a highly entrepreneurial business. Historically, they've been a good allocator of capital. They've continued to make acquisitions in this current market. What we've seen is the SMME sector has suffered, and as a result, Bidvest has actually gained market share in this environment by making acquisitions, by increasing their market shares in most categories. We think that this will continue. We like Bidvest for the fact that they are increasing their foreign earnings profile. They continue to make acquisitions globally, especially within the hygiene business. We've created somewhat of a niche within that business, and we think going forward, a good tailwind could also come from the expanded public works program, where you've seen government now saying potentially going forward they invest a lot more into infrastructure, and Bidvest stands to benefit from many of these trends. So Bidvest is one of those companies, you put it into your bottom drawer, it's there, it's going to produce good cash flows, there's a good management team in place, and over time you will stand to benefit from this company. Maybe more lastly, the last pick I like to speak about is Hyprop. It is a property company. Like all property companies at the moment, they have been impacted by many of the macro headwinds that are present. From 2 years ago, we've seen COVID and the COVID environment, and as a result, many shoppers shop closer to homes, closer centers to their home. Secondly, the consumer has been under pressure, and as a result, they haven't actually gone out to malls and spent as what they could. And lastly, tenants themselves have been unable to pay those kind of rentals, and as a result, we've seen sort of rental reversions actually taking place in the current environment. What do we see and what do we like about Hyprop? Hyprop owns super regional centers, some of the most loved centers in South Africa, from Canal Walk to Rosebank Mall, Hyde Park Corner. And as a result, we think that the super regional center is not dead. We think the model is actually reinventing itself, and it's being used as somewhat a flagship destination for many of the brands to establish themselves and actually have a presence in the market. We've also seen the return from an entertainment offering, where consumers, and especially South Africans, have an affinity to shopping malls, and we've seen that return back in terms of dwell times, where consumers are spending more time. Trading densities have improved from tenants' perspectives, and what you've seen is the negative rentals coming off have now started to slow down, and in fact, in some cases, actually reverse. So we believe at present, Hyprop offers a significant dividend yield of over 11%, trades at a discount in terms of the net asset value, and potentially going forward stands to benefit from much of the upside in terms of the consumer environment going forward as the ship moves back from the convenience retail back in terms of more super regional centers. So yeah, that's it, Valdine. I'll hand back to you.
Thanks, Zaid. Just to highlight, so Zaid's given us AVI, same as Wayne. Spoiler alert, it's the only duplication for today's SA stock picks, but it's lovely to see common thinking and highlighting of similar value propositions. So Zaid is AVI, Bidvest, and Hyprop. And lovely to learn a little bit more about you, Zaid. Don't worry if you can't make up in speed. I think we're all crossing fingers that the speculations around the F1 coming to South Africa will make up for that, or make up for you in South Africa in bringing some speed to South Africa. So we're watching that closely to see if that's another sentiment upbeat for us in SA. Thanks, Zaid. Over to you, Alton. Thank you for joining us. Alton's portfolio manager at Aluwani Capital Partners, and we look forward to hearing from you. Again, just to remind you, let the audience get to know you, so we'd love to hear an interesting fact, and then you can go straight into your picks.
Okay. So something interesting about myself is when I was younger, I played a lot of competitive football, and I wanted to be a professional soccer player. I left school, but those days, the early 90s, professional soccer players didn't earn a lot of money, so the risk reward didn't make much sense for me. So I decided to go to university to study and become a chartered accountant instead. Then if I move into my stock picks, my first pick is MTN. I like MTN for quite a few reasons, actually. So over the last few years, they've been strengthening their balance sheets. They've been selling off non-core assets, paying down debt. They reinvested in the quality of their networks, to the extent that last year they were voted the #1 network provider in South Africa. In March, they were awarded additional spectrum. What this does, it gives them extra capacity on the networks. It gives a better user experience, and they are able to plug additional users into their network without compromising the user experience. Then if we move to Africa, focusing on Nigeria, there's a good opportunity in the data space there. The data growth rates have been very good in Nigeria, and with MTN being the #1 player in Nigeria, we expect them to capitalize and gain a lot of revenue from the data growth opportunity in Nigeria as that progresses. But the most exciting opportunity for me with regards to MTN is actually their mobile money opportunity. So what this is, for those who don't know, mobile money is the ability to conduct financial transactions on your cell phone. The type of financial transactions that they can conduct, or users can conduct on their phone, are send payments to other parts of the country, buy airtime, buy prepaid electricity, pay off debt, etc., etc. So with MTN getting a mobile license in Nigeria in April, Nigeria is quite a big market. There's 200 million adults, 200 million population, about 105 million adults. Of that, about 36% of the population is unbanked or financially excluded. And these type of markets lend itself well to mobile money. So what about 36% of the adult population excluded? That's about 38 million adults roughly that MTN could service from their mobile money business. That doesn't preclude the other close to 70 million adults that could also plug into this mobile money opportunity, because it's so convenient to use. Instead of finding a bank, joining a queue to conduct financial transactions, they can just conduct financial transactions on their phone. So how it works simplistically is you upload money into your digital wallet, you go to an agent, let's say it's 10,000 Naira, upload into your digital wallet. You want to send money to another part of the country, you transfer 1,000 Naira to someone else, MTN make a fee for facilitating the transaction. You want to buy airtime, MTN will make a fee for facilitating the transaction, and so on and so on, buy electricity, etc. So the opportunity set is very big in Nigeria, and the growth rates we've seen in other parts of the country, in other parts of Africa, or in other countries like Ghana and in Kenya. Kenya, they've got Safaricom. They like the poster child for mobile money on the continent. They've experienced growth rates of about 24% compound annual growth rate, CAGR, over the last 11 years. MTN's business in Ghana have achieved compound annual growth rates of about over 40% in the last 5 years. So the opportunity set in Nigeria is very attractive for MTN. My next pick is Netcare. Pre-COVID, Netcare's occupancy rates were at about 60%. And when COVID came, people delayed their elective surgeries. Elective surgeries are like the knee op, the hip replacement, etc., because they didn't want to go into hospital for fear of contracting COVID. So occupancy rates fell off to about 50% or so. Now, with COVID largely behind us, we expect occupancy rates to start ticking up again as people that delayed the elective surgeries go back into hospital for those elective surgeries. So with that happening, we already started to see February, March occupancy rates increase to over 60% in Netcare's case. And with that, elective surgeries are higher margins, so we expect revenues, margins to improve quite a bit. Then there's another opportunity that Netcare face is in the mental health space. They have about 40% market share in the South African mental health market. That's about a 9 billion rand market. And from COVID, people became a lot more aware of their mental health situation. South Africa's mental health challenges are slightly above the world average. So with that, Netcare is very well placed to benefit from this as people seek help for their mental health challenges. So that's our second pick. Our third pick is Mr. Price. Like Mr. Price, because history has shown during challenging times, consumers tend to trade down, and they trade down into operators like Mr. Price, who have lower price points and generally gain market share in this challenging economic environment. They're also a very low-cost operator. They operating cost as a percentage of sales compared to their competitors are much lower, so it stands them in good stead when they're faced with difficult consumer environments. Then they're a very cash-generative business. They made 2 acquisitions recently, Power Fashion and Yappy Shift. They paid cash for those acquisitions, no debt on the balance sheet, good management team. And they've got a few new engines to growth. So the engines to growth that they have is like they launched, like previous years, they launched Mr. Price Sport, Mr. Price Home. They've recently launched Mr. Price School Gear, Mr. Price Baby and Beauty. So now they can play in that school gear market in January when retail sales are traditionally low. Mr. Price Baby, when the new mom goes into Mr. Price to buy something for the baby, she can pick up something for herself, she can pick up something for the other sibling while she's there, or maybe even a husband. So they can cross-sell there and generate further revenue. Then with the Power Fashion acquisition, that gives them entry into the lower end of the market that they previously didn't have access to. And then with Yappy Chef, it's the higher end homeware market, online play that they have access to. So a few engines to grow there. So that's why we like Mr. Price. And those are my picks. Thank you, Valdine.
Thank you, Elton. I thought I misheard you saying you can go to Mr. Price to pick up a husband, but I think you meant gear for a husband too. Yeah, it's a very cool very cool stock picks again, also very diverse. So Elton's picks, MTN, Netcare, and Mr. Price. So thank you for that, and thank you for the background around some of your motivation. And Elton, I have to say, when you told us about what your initial ambition was, which was a professional soccer player, your voice lowered when you said you became a chartered accountant. So hopefully you'll bridge that that unfulfilled passion or ambition in the on the soccer field at some point. Very cool. Thanks for your time. Tatenda, lovely to have you on the show. And Tatenda's added a different flavor. I won't spoil it, but he's gone a little bit off-piste with away from equities. He has 1 equity pick and then 2 other interesting plays. Just to flag, the JSE is a multi-asset class exchange, so all that he recommends can be traded at the exchange as well. So lovely to have your stock picks. Tatenda, tell us something about yourself and then let us hear your thinking.
Yeah, thanks, Valdine. Yeah, I thought I would make things a little bit interesting. Just to mention an interesting thing about myself, I'm a long-suffering Man United fan. So in between checking markets, I'm also checking what's happening in the transfer market to see if we've signed Frank de Jong or what's happening with the Martinez signing. So that's one interesting about myself. I have more than 12 years of experience in the hedge fund market. Having spent my initial 6 years in corporate and the last 6 years at Independent Alternatives. And Independent Alternatives is a hedge fund manager, and we utilize what you call tools of modern finance to invest. So the ability to short sell stocks or bonds or commodities, the ability to use leverage, as well as the ability to invest into derivatives. I'm going to talk about three investment ideas. The first one is long 2048 versus short R186 South African government bonds, which is a flattener yield curve view. The second idea is to buy longer dated JIBOR futures, looking at March 2024 expiry, and that's a forward rates view. And the last idea is going to be, I think, something more appropriate for this platform, which is buy Shoprite, which is a quality and defensive view. Turning over to the first idea, so the 2048, the R2048 government bond is a back-end bond, and it's the longest maturity bond in the All Bond Index and really a proxy for the 30-year area. The R186 is a front-end bond and is a proxy for the five-year area. And we think that the South African government bond yield curve will continue to flatten as a result of both bearish and bullish factors. And when the yield curve flattens, it means that the spread between these two bonds compresses. And currently the spread is trading at 260, and we see this compressing to around 150 to 100 as a result of bullish and bearish scenarios. And this will happen as a result of maybe back-end yields coming down much more than front-end yields, or the front-end yields will push up higher than the back-end yields. And we think a combination of these two scenarios will happen. First, let's look at the bear scenario. We expect bear flattening as a result of interest rates being hiked, because usually the yield curve tends to flatten when rates are hiked. And the reason is that interest rate hikes tend to affect the front end of the yield curve much more than the back end. And there are a number of reasons for that, but we think that this dynamic will result in the R186 bond yields rising much higher than the R2048 bond yields. Turning over to the bullish scenario, we expect bull flattening as a result of the long-term debt cycle for South Africa continuing to improve. For example, higher inflation will result in higher nominal growth, and that's going to help debt to GDP to fall. Also, terms of trade have been quite supportive for South Africa, and they've resulted in better revenue generation for the fiscus. And that dynamic will result in the budget deficit narrowing and much less bonds being issued by Treasury, and that will result in the R2048 bonds yield falling much more than the R186 bond yields. Turning over to my second idea, and this is buying JIBOR futures as a result of a more aggressive than warranted interest rate hiking cycle being discounted by the fixed income derivatives market. I think given the broader global growth, inflation, and central bank dynamics, the market is discounting significant interest rate hikes over the next 2 years, which we do not think will materialize given our SA specific dynamics. We use JIBOR futures to back out the market's expectation for future interest rates, and the market is currently pricing a terminal repo rate of around 8.4% using the March 2024 futures. And with JIBOR at 5%, the market is pricing in a further 340 basis points in interest rate hikes over the next 2 years, on top of the 125 hikes that has already been done, and that will make a total of 465 basis points of hikes for this cycle, which is one of the steepest hiking cycles in recent memory. And just to put this into perspective, the previous cycle was around 200 basis points. And also, if you look at the subs forward guidance using the QPM model, it's pricing in a terminal repo rate of 6.5. Therefore, this opportunity represents a significant opportunity because there's a big discrepancy, and we see around 200 basis points of potential profit as interest rates, as JIBOR rates converge to a much lower repo rate. 6.5 is what we think will be much more realistic. And we like JIBOR futures because of the inherent leverage that you get embedded in futures. And as a result, a fixed income trade can show equity-like returns. My last idea is a stock idea, and in an environment of slowing growth and high inflation, we like quality defensive businesses which are growing earnings, and we like food retailers at this point of the business cycle. And in terms of higher food price inflation, food retailers have their nominal earnings tend to increase during these periods. And food retailers have historically managed to pass on inflation to the consumer, and we expect this to be the case this time around. If you look at food prices, they've risen quite significantly, higher on the back of a tight global market in 2021, and also in much more recent in 2022 as a result of the Russia-Ukraine conflict. You also have a weakening currency, which is also worsening the situation as import prices are pushing much higher. And we think that food price inflation will remain higher for some time. Food is also a very defensive sector, and in the event of a more prolonged growth scare, we think that food retailers tend to be more resilient. And of the food producers, of the food retailers, we like Shoprite because it's much more defensively positioned in terms of its target market, and it also has better management in our view, and also it's increasing market share. A good case in point is their Checkers 60/60 app, which has gained tremendous traction and is probably the fastest grocery app around. You're also seeing productivity improving within the company, and also their loyalty programs are bringing more customer engagement. We're also seeing a much more disciplined approach to expansion, and the focus is now tend to more development and acquisitions in South Africa as opposed to the Africa expansion. And so we like Shoprite. The PE is a little bit higher, but we don't mind paying a slightly higher PE for such a quality and defensive business at this point of the cycle. Those are my 3 picks for this afternoon. Thank you.
Thank you. Thanks, Tatenda. So even though this is SA Stock Picks, Tatenda added a new flavor, but just to recap for Tatenda, he suggests buying Shoprite, and Shoprite we all know from a consumer play perspective. And then on the 2 fixed income products, he has suggested doing a yield play, which is buying a longer dated government bond, being the R2044 versus selling the R186. Those are 2 government bonds, but just trying to extract a yield, and then buying JIBOR futures. And I would really encourage you to chat or get more knowledge regarding the derivatives market if you are interested, and very happy for the JSE to connect as well with some understanding. So there you have it. Tatenda, on our first show, we had a Arsenal house. It wasn't by design. And as a long-suffering Arsenal household ourselves, we empathize with you as a Man United supporter. No. So guys, it's been really awesome, and as mentioned, we've had some really diverse thoughts. Thank you to the speakers. I just want to quickly highlight some of the questions that we've got. There's 2 stock-specific questions as well as 2 just general questions. I'm going to couple the 2 general questions because I think they are related. So one saying some analysts say that this bear market recession will last 18 months. Is cash or cash-like investments best? And another question, similar from a global perspective, is as the recession seems far from ending, is it possible to concentrate my portfolio into dividend kings and aristocrats rather than growth stocks? So looking if they should go a dividend versus a growth play. So maybe if one of the speakers would like to cover those together as a general view. If not, also happy to skip. Any volunteers? And then the other one's one for you. I'll come back to it, Alton, on MTN, and one for you, Wayne, specifically on Impala. But let's try and do the general question first. Any volunteers? Wayne, thank you. Go for it.
I'll just talk generally. The ideas that are being proposed there to go, I suppose, value over growth and cash over shares are wonderful ideas if you had them a year ago. It's too late to do that now. You know, we are hitting somewhere near probably the bottom of this equity market correction. You know, I estimate maybe there's another 10% to go, but we've had the majority. The next thing we should all be thinking about, and in fact, the next thing we should all be doing is buying shares, not going into cash, and buying growth and not going into value per se. And I'm talking very specifically there. I know my stock picks were value picks, talking specifically about the shares that have taken the most punishment, and that is big tech shares. You know, human emotions are contrary to market cycles. They're totally different. You know, when you're happy, you should be selling, and when you're sad, you should be buying, because we're all sad now because it's the bear market and no one likes bear markets and everyone wants to know cash is king. But now you should be considering actually buying shares, not selling shares, and not de-risking your portfolio.
Thanks, Wayne. Alton, a question for you specifically on MTN. Why is MTN always paying fines to Nigeria? Regulatory environment question.
Yeah, so they have been found guilty in the past of not disconnecting unregistered SIM providers, and then they got into trouble with the tax authorities there. You know, the relationship has improved over the last few years with MTN and the Nigerian authorities, especially with them separately listed part of the Nigerian business. So I think that the potential for them to pay fines might be less going forward. But with this mobile money opportunity, I do think that the government there or the authorities will want their share of the success, so in the form of taxes or fees, whatever they impose on the mobile money business. So we're expecting less fines in Nigeria, but you can never rule that out. That's always a risk in African countries when the fiscus is under pressure and they're looking to raise cash somehow. So that is a risk to the view somehow.
Thank you, Alton. Wayne, it wasn't specifically a question on Impala. I've just reread it now. It's some advice, but I'll read it out, and then perhaps with your permission, we can connect yourself and Rodney and Kosi, who this has come up to. Rodney's basically saying, question to Wayne, I have 95,000 Rand to invest into the bear market, and I'm also interested to invest in Impala. My question is, how much would you invest into Impala if you had 95,000 Rand? So it's very specific to Rodney's situation. So with your permission, we'll try connect you to, if that's okay. Tatenda, a question for you is, there are risks to food retailers of government clamping down on increasing food prices. We are seeing the same in the US, where the US president is calling on decreasing in petrol prices. So just a question in general regarding risks to food retailers with regard to that context. Any thoughts?
Yeah, well, I don't think it's a real risk, because it has never happened. We have a much more open economy, and I think the fundamentals will come out on tops. So I think the other risks to the view or to the trade, and I think one of them just being the general market, which is quite weak. But I don't think food price controls is something that we have to worry about in the South African context.
Great, thank you. So guys, we are out of time on the SA Stock Pick session. Always sharp and punchy and very informative. A quick recap. Wayne's given us AVI, Momentum Metropolitan and Impala Platinum. Zaid's covered Bidvest, AVI and Hyprop. Alton, Mr. Price, Netcare and MTN, and Tatenda Shoprite, JIBAR futures, and buying the R2044 bonds versus selling the R186 bonds. Again, it's a government bond yield play that he's given us. I know there's a question on how to get tickers to get interest into Gavi bonds. I'll ask the JSE team to just post that as a general FYI. And a huge thank you to our speakers. I know, Wayne, you said that this is not a competition. It's definitely not, but hold the line. We're going to introduce you to a JSE, legitimate JSE competition shortly. But we might invite you back, Wayne, even though it's not a competition, in 6 months or 9 months to tell us, give us some reflections on your stock picks a few months later, as well as any new thoughts or as the markets turn so quickly. So a huge thank you to our speakers. We will pop up their stock picks as a recap through our social media platforms. And again, to highlight, there is a replay of the session soon. So the JSE competition, as I've just mentioned, so we are always thrilled to highlight our yearly competition. We've been running it for a few years now. It's called the JSE Virtual Game. And what we're trying to do with this is the objective to drive financial literacy. So through engagements like SA Stock Picks, it's just to drive awareness. So the competition aims to teach South Africans of all ages fundamentals about listing, thinking about the markets, raising awareness of how you can deploy money. And we ask the contestants to test their trading skills through the most pragmatic way, a simulated trading program where their performance is tracked and measured. So there's no hard cash P&L or profit and loss exposure, but it's the best efforts to simulate through a virtual trading game. If you want more information, we have a promo video that's going to come up shortly, but to learn more and to register, it's still open at the moment. So please visit www.virtualtradinggame.jse.co.za. And as mentioned, if you stay tuned, we've got a short promo video so you can take a screenshot to get more information. Thank you to our guests, Wayne, Zaid, Tatenda, and Alton. Lovely to have your insights. And as always, thank you to our esteemed guests who have dialed in and put your time and effort to share some comments through the session. Always lovely to engage, and please feel free to reach out. I'm Valdine from the JSE. Very happy to engage with you where relevant. So thanks, guys. Have a good afternoon, and just stay tuned for a short moment longer for our promo video on the virtual trading game. Thank you. Bye-bye.
Do you want to learn about the stock market, test your investment skills, and stand a chance to win amazing prizes at the same time? Then the JSE Virtual Trading Game is the game for you. It's an online trading competition that simulates real trading in a risk-free game environment. The competition gives you a chance to learn all about investing on the JSE and to develop your research and strategy skills around the trading of JSE-listed instruments. Each competitor will get a virtual 1 million rand to build an investment portfolio. Player performances are tracked and measured, and the players who build the most valuable portfolios will win their share of 100,000 rand in prizes in the form of Satrix vouchers. That's right, the game is simulated, but the prizes are real. Don't miss out. To enter, register now at virtualtradinggame.jse.co.za.